Good morning, everybody. I hope you are having a great morning so far. And thank you for joining us on our webinar on transfer pricing. This topic that we have selected today is basically to make all the businesses aware of certain things, specifically with respect to transfer pricing, which is critical because as per the transitional rules, when we move from a non-tax period to a tax period, there are certain adjustments with respect to the accounts that the businesses are required to do, and one of them is transfer pricing. So we will proceed with this webinar. I'll just take you through certain critical amendments which have come with respect to the free zone taxability first. Just a couple of points on that, and then we will move on the transfer pricing topic of the webinar for the day. So we are all aware that the corporate tax law, which is Federal Decree Law number 47 of 2022, was released almost a year back, and it had sort of indicated that the cabinets of the UAE and the Minister of Finance of the UAE will be releasing various decisions that will complement the corporate tax law. Specifically with respect to the free zone taxability, Article 18 details what conditions and what requirements are to be met for a free zone person to be a qualifying free zone person. We have already dealt with that. We already conducted a seminar a couple of weeks ago on qualifying free zone person and what requirements are needed to be fulfilled by the businesses. Accordingly, the cabinet released the decision 55 of 2023 and a ministerial decision of 139 of 2023 were released. We all are aware that there were a bit of ambiguity in the way the law was drafted at that time. And as per the rumors around in the market, the government came to know about it. Even when the Minister of Finance conducted corporate tax awareness sessions, they clearly mentioned or told in the webinars and even the Ministry of Finance in the various press conferences, they mentioned that the intention of the government is not to tax certain type of businesses or all businesses in the free zone. And accordingly, the Ministry of Finance came out with a public consultation document specifically on the free zone taxability. And all of us, all the stakeholders, including us, we provided our comments, and we were waiting for the revised cabinet decisions and the ministerial decision. On 3rd of November, that is last Friday, the minister released the ministerial decision 265, which replaced the earlier ministerial decision 139. That was repealed, and now we have 265 of 2023. Likewise, the cabinet decision 55 was repealed and replaced with cabinet decision 100 of 2023. Now let us quickly see what changes are there as compared to the two cabinet decisions and the two ministerial decisions quickly. If you see Article 3 of Cabinet Decision 100, there's only one change as compared to the earlier decision. Now, qualifying income also includes ownership or exploitation of qualifying intellectual property. What is qualifying intellectual property? We'll just come to that in a while. This particular clause was, or subclause or category of income was under the excluded activity in the earlier cabinet decision. So now any transaction with a free zone person except income derived from excluded activity are qualifying income and can be considered for a preferential rate of 0%. Likewise, any transaction by the free zone company with a non-free zone persons, that is in the mainland or outside of the UAE, any income with respect to qualifying activities can only be considered or will only be considered as a qualifying income. Likewise, qualifying intellectual property, if any zone person is earning some sort of an income, will be considered as a qualifying income and will be considered for the 0% taxability. All these subject to any other income that the company has, which is from the either from excluded activity or from non-qualifying activities. Then again, as we are aware, there is a de minimis requirement, and if it is that's a threshold of 5 million or 5%, whichever is lower. So we will apply that to come to a qualifying income. Again, the exceptions remain the same. Qualifying income, any income attributable to a domestic permanent establishment or a foreign permanent establishment is not to be considered for deriving the qualifying income. Likewise, any ownership or exploitation of immovable property located in a free zone, income derived from that, it's basically outside of the free zone, income derived from that will be an exception. Likewise, income from non-qualifying intellectual property again will not be considered as a qualifying income. Now, what are the qualifying activities? Are there any changes? Let's just have a quick look. As per the ministerial decision 265, in the qualifying activities, there is an addition of trading of qualifying commodities. What does this mean? This means that now if any company in a free zone is trading in a qualifying commodities, again we'll come to know what qualifying commodities in, and it has to be in a physical form or any derivative related to that physical form of trading that a company is conducting will be considered for a qualifying activity, and income generating out of it will be considered for as a qualifying income for 0% taxability. Coming back to the second edition, earlier it was holding of shares and securities. If you have sort of if you have sort of read the guide and all, even the trading in shares and securities were considered as the qualifying activity. But now the new definition says, or the new qualifying activity says, holding of shares and other securities for investment purposes. And what does investment purposes mean? You should hold this shares and other securities for at least 12 months of a continuous period. Rest, if you see, there are certain aspects there: reinsurance services, fund management services, wealth and investment management services. They earlier were subject to regulatory oversight of a competent authority in the state. Now, this subject to regulatory oversight of competent authority is not being mentioned specifically. So now, let us go through what some definitions are there with respect to the new editions. So what is qualifying commodity? A qualifying commodity can be any metal, mineral, energy, or agricultural commodity that are traded on a recognized commodity exchange market in raw form. So any company dealing in these type of metals or minerals or energy that are traded in a recognized commodity exchange will be considered as a qualifying commodity. And now, what is a recognized commodity exchange market? That is any commodity exchange market established in either UAE, and that is licensed and regulated by any relevant competent authority, or any commodity exchange market world over that is on the same level as of UAE, same standing as of UAE. So those commodity exchanges will be considered as recognized commodity exchanges. To give an example, in UAE, DGCX, Dubai Gold and Commodity Exchange. So any commodity or any metals, minerals traded in that particular exchange or any other exchange globally, such metals, minerals, and agricultural commodities will be considered for treated as a qualifying commodity. Now, quickly, as we discussed, the qualifying intellectual property, these are basically patented and copyrighted software that is equivalent to a patent and registered, and you have some sort of a patent for that. And if you are generating any income from that, can be considered as an intellectual property right. But any trademark or such thing which is exclusively used for marketing related stuff will not be considered as a qualifying investment property. And quickly, if we go to patent, what are patents? Any patent granted under the law regulating patent in the state or granted under the relevant law of a foreign jurisdiction. So any patent registered will be considered as uh, uh, qualifying intellectual property. Likewise, any copyrighted software registered under any copyright law in either the UAE or any foreign country will be considered as qualifying investment property. At this point in time, since our topic of the day is transfer pricing, I will not take much time on the free zone taxability, but we promise to come with a date soon for a webinar on transfer pricing, on the free zone taxability. Maybe we will have a webinar soon on that. Now, coming to the topic of transfer pricing, this is very critical, as I mentioned, because we want all the businesses to be up and ready before they enter the first financial year. So under the transfer pricing topics, what we are going to cover is the corporate tax law. Article 34 deals with arm's length principle. We'll talk about what that is. We'll learn more about that, learn more about related parties and controls, learn more about same-way payment to connected person. Then ministerial decision number 97 of 2023, which gives some sort of guidance on what documentation requirements are there for the transfer pricing requirement. Transfer pricing, as we all know, forms part of tax, but it's not a direct corporate tax itself. This is basically sort of coming from the OECD's guidelines of profit shifting and base erosion and profit shifting. So this is transfer pricing is something very critical, and most of the countries where the taxation is matured, they take it very seriously. So there are separate transfer pricing audits also happening by the authorities. And we will also look into what the transfer pricing guide says for which was issued by FTA. Now, before we jump or come to go ahead with this, we'll just like to have a quick poll to understand. Are you familiar? There's a question on the screen. Are you familiar with transfer pricing regulations and guidelines? Maybe in UAE or any other country, you may answer yes, no, somewhat, or I want to learn more. Just wait for a couple of more seconds and then we'll proceed. Great. Let's proceed. Now, this will help us also to give some more perspective on what transfer pricing is. So almost about 70% of the participants are saying that they want to learn more or they are aware of somewhat about the transfer pricing. I'll not take much time on the transfer pricing. I'll let Bhavya, our transfer pricing expert, speak on the topic. But just to bring some sort of a perspective, I'll just try to make you understand why it is relevant and why is this important. First of all, let's look after the applicability. The transfer pricing is, as the term, if we simply say that the transfer pricing is basically between the related parties. But for UAE, there's something. The Ministry of Finance has expanded the scope of transfer pricing. They have broadened it by bringing the connected persons into the transfer pricing regime. Why it is so? Because obviously, as we are all aware, there is no personal income tax. And that's the reason they brought the connected persons into the fold of transfer pricing. So transfer pricing is largely for two persons, related parties. Related party can be by ownership, by control, direct or indirect, and connected persons may be the shareholder, the director, and up to the fourth kinship. We'll come back to that a little later, again in detail, when Bhavya talks about this thing. Then the second and more important point is, this is also relevant because the transitional rules require certain adjustments, as I was mentioning earlier, in the balance sheet of the immediate preceding the first tax period. So most of us, most of the businesses in the UAE, we are aware that have related parties either within the UAE or within the main, in the mainland of free zones and outside of UAE. So a lot of transactions happens, and typically, there has been some sort of profit shifting elements happening. That's the reason why the transfer pricing is kicked in. And the first closing, so suppose if the commonly the common financial year here is Jan to December. So our first, for those who are having Jan to December as their financial year, 31st December 2023, the closing balances on that day will be the opening balances for the first tax period. And the law says that all the balances with respect to the related parties and any transactions with respect to the related parties must reflect arm's length principle or arm's length pricing. So if we have some sort of a related party balances on 31st December and it's not under the arm's length pricing, then probably at the time of filing the return, we'll have to do the adjustment then. And instead of that, it's always better that we are all clear and do it right now. Maybe suppose there is an inventory happening, we'll have to give an adjustment to inventory. Just for an example. Also, with respect to qualifying free zone person, one of the conditions is that in the qualifying free zone person is that the qualifying free zone person, in order to be a qualifying free zone person, must comply with the arm's length principle and transfer pricing documentation. So from that also, transfer pricing is critical. So what sort of documentations are required? Bhavya will take it to further detail, but I'll just quickly say that why transfer pricing document is essential, because it gives some sort of a documentation for the arm's length, on the arm's length pricing and the profit of taxable persons, if it's properly calculated or not. And this document will also be made available to the tax authorities as and when they are requiring it. And more importantly, the onus is on the taxable person to prove control transactions are at arm's length pricing. And what are the transfer pricing documentations what we're talking about? The first thing is there will be a transfer pricing disclosure form which will be devised by FTA. It's not yet released, will be happening soon, which will cover all the details of the controlled transaction. And that has to be submitted together with the together with the tax returns. Then there's a requirement of preparing master file and local file. And as per the ministerial decision, it's required if your turnover exceeds 200 million. What exactly it is, the details of it, we'll come to know about that. And also country by country reporting. Few of you must be already aware what country by country reporting is, because it's started along together with the economic substance regulation 3 years back. And if it's a multinational enterprise, and if your consolidated turnover is more than 3.15 billion dirhams, you would already be filing that particular report with the authorities. Going back, I'll request Bhavya to take it over from here. Thanks.
Thank you, Raj, and good morning, everyone. So now I'll take you through the latest transfer pricing regulations in UAE, what it contains, its applicability, the documentation requirements, and what we can do right now to be future ready and TP compliant. So the UAE Federal Tax Authority has been gradually introducing guides and publications to the various aspects covered in the UAE corporate tax law. On this slide, I have put the various relevant decrees, circulars for a transfer pricing perspective. In the most recent publication, dated 23rd October 2023, the FTA has issued an extensive 140-pager transfer pricing guide. The guide offers insights as well as it has a lot of illustrations on various aspects of the UAE transfer pricing regime. For example, guidance on the application of the arm's length principle, TP documentation, considerations for specific transactions such as financial transactions, intra-group services, intangibles, etc., as well as TP audits, risk assessments have been provided in the guide. So essentially, the guide is based on the 2022 OECD transfer pricing guidelines. And although the guide will not is not really a legally binding document, it will be the primary source of guidance for transfer pricing related matters going forward and can be used as an indication of how the FTA will apply the transfer pricing regime. So mainly the taxpayers should rely primarily on the corporate tax law, that is the decree number 47, the ministerial decision number 97 of 2023, cabinet resolution number 44 of 2020, which talked about the CBCR guidelines, and the guide for the transfer pricing, which has been recently issued. So since almost 70% of you said that we want to know more about transfer pricing, so let me just briefly explain what transfer pricing is. So transfer pricing, or as we know it as the arm's length principle, it means that the transactions between related parties, and in the UAE context, even with connected persons, need to be at a similar rate as if they are being undertaken between independent parties. So simply speaking, it means that the transfer price between related parties should not be manipulated to shift the taxable profit base to a related entity or a connected person, which is subject to a lower rate of tax. So the main idea of the transfer pricing regime is to avoid shifting of the tax base to another tax jurisdiction or to a connected person. Now, the articles, they have been also discussed by Raj, but I'll quickly just touch upon them. So the federal decree law talked about these articles in respect to transfer pricing. Article 1, it gives certain definitions related to related party, connected persons, meaning of control, etc. Article 34 talks about the arm's length principle. 35 and 36 talk about related parties and control and payments to connected persons. And 55 gives the guidance on the transfer pricing documentation that needs to be maintained. Now coming to the arm's length principle. So Article 34 and the transfer pricing guide, it mentions that arm's length principle means the transactions between related parties and the connected persons should be at a similar price or margins as it would have been for similar transactions between independent or unrelated parties. So just to give a very simple example to put this point, to give perspective to this arm's length principle. So there's A Limited in US, which is selling 1 kg of food grains to its subsidiary B Limited in Dubai at 100 dirhams per kg. Now, a similar food grain is available in the market for 60 dirhams per kg. Now here TP will kick in. So first, A Limited and B Limited will be considered as related parties since they have a parent and a subsidiary relationship, and the shareholding structure, control, and all those aspects we assume are being met. Second, the price of 60 dirham, which is the independent party transaction will be taken as an arm's length price for the transaction of 100 dirhams between the related parties. So 60 dirhams is the price which an independent entity is dealing with in the open market. And another aspect is that in case your transaction is not at an arm's length, then there can be certain adjustments to the profits under the transfer pricing rules. So now coming to some important aspects that the transfer pricing guide has provided for application of the arm's length principle. The guide talks about accurately identifying the transactions subject to transfer pricing, as well as understanding the commercial and financial relations between the transactions. So the guide has emphasized on the importance of the functional analysis. The functional analysis exercise is one of the critical elements for determining the arm's length price of controlled transactions, and it is undertaken to identify the economically significant activities performed, assets used, and the risks that are borne by the respective transacting parties. So in line with the OECD TP guidelines, a 6-step framework has been provided, even in the transfer pricing guide, UAE TP guide, for analyzing the risks under the functional analysis. Now, while analyzing the risks, the FTA expects the taxpayers to undertake a thorough functional analysis to determine what risks have been borne, what is the impact of these risks, and which party bears these risks. The guide offers practical guidance to taxpayers by presenting a comprehensive illustration of how to document the functional analysis. Now, further, after the functional and the risk analysis is complete, one needs to undertake a comparability analysis to identify the independent comparable providing similar products or services within same economic and market circumstances. While doing so, special considerations will have to be kept in mind with regard to market conditions, economic conditions, and issues such as whether any losses are being incurred, etc. So all this is provided in the guide. Now, briefly, I'll touch upon what is related parties. So Article 35, it defines related party and control. The definitions for related parties and connected persons in the guide are aligned with the definitions noted in Article 35 and 36 of the Corporate Tax Law. The guide offers multiple examples to demonstrate how the definitions of related parties or connected persons may be applied by taxpayers in respect of their operations in the UAE. Broadly, if the shareholding is more than 50%, or if control exists, then the parties are considered as related parties. Now, through various illustrations provided in the guide, it becomes apparent that the determination of control is not solely reliant on a specified 50% ownership threshold. So instead, control can be established even when one person exercises significant influence over another person. I have put in an example of control in the subsequent slide. So now coming to connected persons. So a person will be considered as connected to a business if at least one of the following conditions is met. He's an owner of the business, a director or a key managerial person in the business, a related party of any of the above. That is a relative within the 4th degree of kinship or affiliation. So the meaning of related parties and the connected persons is very wide in the UAE context and will need to be analyzed on a case-to-case basis for application of transfer pricing provisions. So now I want to take a quick poll on whether you have identified your connected persons or not. So let's just take around 10 seconds Okay, so I'm closing this poll. So it is, so 76% of people are saying that yes, and 24% are saying no. So I think that the ones who have already done it, it's really good. However, the ones who've not done it, it is very important that you now identify the connected persons, because they will also be covered by the transfer pricing regulations. And it is highly imperative to maintain proper documentation. As we'll see in the later slides, there can be tax audit implications as well. Now, this is an example that I have picked up of an illustration of control from the transfer pricing guide. So it just goes on to show that how control can be established. So in this case, the company X is a UAE company that is 51% owned by company A and 49% by company Y. While company A owns a majority interest in company X, the management of day-to-day operations, development of strategies, and formulation of the key market decisions are the functions of company Y. So now, based on the above, it can be established that company Y has control over company X, even though the shareholding is 49%. So it is below 50% due to the key role in the market decisions. So in this case, both company A and company Y would be considered related parties of company X through ownership and control respectively. Now, coming to a few pointers on the key impact for taxpayers of the transfer pricing guide. So the taxpayers must evaluate and assess their relationship with other persons, any natural person or juridical person as defined under Article 1 of the Corporate Tax Law, to determine the applicability of any of the related party or connected persons definitions, either via kinship or ownership or control, and exercise of significant influence, as well as the applicability of the connected persons definition. So it is the primary responsibility of the taxpayers to conduct a self-assessment to determine whether a person exercises significant influence, thus potentially classifying that person as a related party. Now, coming to another important aspect of transfer pricing, the TP methods that have been prescribed. So to arrive at the arm's length price, there are broad 5 methods which are used across the world and also have been prescribed by the federal decree law. They are the comparable uncontrolled price, resale price method, the cost plus method, profit split method, and the transactional net margin method. Now, all these methods, they have applicability to specific situations. So you cannot just pick up one method and apply it without doing the groundwork. So for example, the cup method, it compares the price charged for property or services transferred in a controlled transaction to the price charged in a comparable uncontrolled transaction in comparable circumstances. Strict comparability is required to apply cup method. Now, for example, the cost plus method, it considers the direct and indirect costs incurred by a supplier in supplying goods or services in a controlled transaction and applies an appropriate markup to these costs based on the functions performed by the supplier and the profit that would have been earned from an arm's length transaction depending on the market conditions. So CPM is usually applied in case of provision of services or supply of semi-finished goods. Now, coming to transactional net margin method, it examines the net profit earned from a controlled transaction relative to an appropriate base, such as the cost, sales, or assets. Profit split method is applicable in the case where the related parties are engaged in highly integrated business operations, or where each of the parties to a controlled transaction make unique and valuable contributions or use unique and valuable intangibles in relation to the controlled transaction. So profits are split on some allocation basis within the group. Now the guide has further provided that where none of the 5 methods can be applied, then other methods can be considered for the purpose of determination of the arm's length price. However, where an alternative TP method has been used, it is very important to maintain the adequate supporting documentation, and this is also emphasized in the transfer pricing guide. So this documentation must provide reasons for selecting this other method, including reasonable, sufficient economic and commercial rationale, etc. Now, an important question which arises is that which method to select as the most appropriate method. So the guide has also given some guidance in this respect. So for the purpose of selecting the most appropriate method, the guide provides that the taxpayers should consider the nature of the transactions, the functional analysis, availability of reliable comparable information, which is very important, then the degree of the comparability of controlled transactions and uncontrolled transactions. The guide provides that the FTA's preferred approach is for TP methods to be applied at the respective transaction level wherever possible, and the taxpayer may opt to apply the TNMM or any other method on a company-wide basis as well to corroborate the results which are obtained from the separate analysis performed on a transactional basis. Further, there may be situations where the activities, transactions are sufficiently interlinked from a commercial and economic standpoint, and in those cases, it may be possible to rely on an analysis where the taxpayer aggregates the transactions by adopting a company-wide analysis to test the arm's length nature of the controlled transactions. Now, coming to the transfer pricing documentation requirements. So there are essentially four requirements. The disclosure form has yet not been notified. However, it essentially will consist of the nature of the controlled transaction, their value, details of the related parties or connected persons, and the TP method used to determine the arm's length price. The master file will provide a high-level overview of the group's business and the allocation of income and economic activity within a group, which primarily includes organizational structure, description of business, intangibles, intercompany financial arrangements, financial positions, etc. So as per the ministerial decision number 97, certain thresholds were provided for the master file and the local file. The local file is essentially a transfer pricing study report. So it identifies the transactions with related parties or connected persons. It will have a detailed description of the transactions, functional analysis, industry overview, economic or the benchmarking analysis. Coming to CBCR, the country by country reporting, the UAE has introduced the CBCR requirements through the Cabinet Resolution number 44 of 2020, and it applies to very large MNCs with a total consolidated revenue that is equal to or more than AED 3.15 billion. Now, coming to the key takeaways or key impact for the taxpayers is that it is very important to note that while there are certain categories of transactions which might not be required to be documented in a local file, those control transactions should still be undertaken at an arm's length basis. So overall, taxpayers are required to maintain appropriate supporting documents to justify the arm's length nature of the controlled transactions, even though the prescribed thresholds, conditions to maintain TP documentation is not met. So all throughout the transfer pricing guide, if we see, there is an increased emphasis on the maintenance of the documentation, the main documentation as well as the supporting documentation, which will demonstrate that the transactions are at an arm's length price. Now, another point that I wanted to touch upon was that the TP guide, it has provided guidance with respect to certain specific transactions, and this is also in line with the OECD transfer pricing guidelines. So, for example, financial transactions. So there are separate chapters in the OECD transfer pricing guidelines dedicated to intangibles, financial transactions, intra-group services, etc. So in the transfer pricing guide, the UAE transfer pricing guide with respect to financial transactions, it says that immediate steps should be taken to put in place an appropriate pricing mechanism which aligns with the arm's length principles for both existing and future financial transactions. Then with respect to the outstanding balances, it says that taxpayers should ensure that the outstanding balances on account of controlled transactions are settled within a reasonable time, and the credit policy for controlled transactions is in line with what is offered in third-party contracts. So just to put things in perspective, I'll just give an example of the Indian context. So interest on outstanding accounts receivable is considered as an international transaction. Now coming to intra-group services, the benefit test has to be satisfied. It is determined by evaluating whether independent parties in comparable circumstances would have been willing to pay for the activity if performed by an independent service provider or would have performed the activity in-house. The guide elaborates on the various aspects required to be considered, like shareholder activities, treatment of pass-through costs, reimbursement of expenses, duplication of activities, etc. With respect to intangibles, it says that the taxpayers should undertake appropriate DEMPE analysis to identify any intangibles existing within the group for which appropriate remuneration should be charged. Now, in cases where the taxpayers are evaluating the option to undertake business restructuring within the group, it will be important for them to evaluate the transfer pricing implications and take appropriate steps to ensure that the appropriate documents, workings are maintained to support the arm's length remuneration of such transactions. Now, coming to the transfer pricing audit, so as the law provides, the FTA will review the submissions made by the taxpayers and undertake tax audits. So the guide provides the following points in relation to the TP audit. So the burden of proof will be on the taxpayer. The onus will be on the taxpayer to prove that the transactions are at an arm's length. So again, very strong or a foolproof documentation will come into play here. Further, there may be cases where transfer pricing adjustments are required, where the controlled transaction is not as per the arm's length principle. So the guide provides that these adjustments can be made either by the FTA or by the taxpayer. Further, the FTA also has the power to disregard the controlled transaction and replace it with an alternative transaction in cases where the transaction is not found to be one that an independent party would adopt. So this is non-recognition principle is in line with what a lot of nations across the world have been following, especially by way of their case laws. Now, coming to the most important part of this presentation, the key action points that need to be ensured. So a transfer pricing policy is like a pre-facto analysis. This document is prepared in advance of the international transactions to determine that what is the arm's length compensation expected from a transaction. This helps in structuring the business which will comply with the transfer pricing requirements. So a transfer pricing policy will identify the transactions with related parties or connected persons, will have a detailed description of the transactions and their functional analysis, economic or benchmarking analysis. A transfer pricing policy will lay down the multinationals policy regarding the application and implementation of transfer pricing rules and help the tax finance department to ensure correct pricing. Now, I want to again just put in a poll here with relation to how many of you have a transfer pricing policy in place. Okay. So around 78% people have said they don't have a transfer pricing policy in place. 17% are saying yes, which has been prepared by the UAE entity. And 4% are saying yes, a global transfer pricing policy. And the numbers have changed a little now. 79% are saying no, we don't have a transfer pricing policy in place. So it is highly imperative. The point of this poll was to understand that how many of you don't have a transfer pricing policy in place, and to bring across the point that it is very important to document your intra-group relationships or your pricing by way of a transfer pricing policy. So now the key action points for a taxable person is that it is important for taxpayers to revisit their existing TP policies and take appropriate steps to align them with the arm's length principle. In cases where taxpayers do not have a transfer pricing policy for the controlled transactions, it is imperative to undertake analysis to put in place an appropriate TP policy. The taxpayers should also put in place the mechanism to prepare and maintain comprehensive TP documentation backed by additional supporting information to demonstrate the arm's length nature of the controlled transactions. So these are a few suggestions from our side that you can do right now. So one is review your intercompany arrangements, determine the related parties and connected persons, determine the transactions to which transfer pricing will apply, prepare transfer pricing policy to ensure the intercompany transactions will meet the arm's length standard. So with this, I come to the end of my presentation.
Bhavya, I have one question. There is a question here. I just thought I'll just ask you. One of the participants is asking that even if our turnover is not 200 million, do we still, but we have intercompany transactions and connected person payments. So do we still need to have any sort of documentation? Because master file and local file are not required to be submitted.
Right. So the master file and local file is not required to be submitted, but we need to understand that the guidelines has emphasized that your transactions need to be at an arm's length. So even the disclosure form has not yet been notified, and the thresholds for the disclosure form are also not yet notified. So again, it depends on the quantum of the transactions that you have. But to be on the safer side, it is always better to have some sort of a documentation which goes on to establish that your transactions are at an arm's length. Again, I think it will be a very case-specific decision that probably you can take depending on the quantum.
Sure. Thanks. Just to add to what Bhavya has mentioned, the law today, as it stands, prescribes that FTA will give the taxable person a maximum of 30 days to provide the transfer pricing documentation when asked. So it is always better and critical for all the businesses to have a transfer pricing documentation, even if the threshold is not breached, the 200 million threshold of turnover is not breached, because there would definitely be some sort of an intercompany transaction and payments to the connected persons, say to shareholders and also a director, salaries paid to them, or maybe rentals, or maybe some sort of royalty on the registration of trademarks or brands, IPRs. So we thank you all for joining us today. And as we had mentioned, we will have a webinar on free zone taxability very soon. Please do keep a watch on our emails from our team. And thank you all.
Thank you, everybody.